Hey, Mike Swanson here of Wall Street Window. Last week, we saw the stock market go up for 3 days, and that has brought, I can tell you, some new excitement in the market that we haven't seen for the past couple of weeks. I was looking over the market charts this weekend and emails I'm getting. I've gotten several emails from people asking me about buying things, and also the comments I'm seeing of traders on Twitter. Most of them that I've read, they're predicting big gains to come. One fact that people are pointing to is that 90% of the volume on Friday was buying volume on the New York Stock Exchange. And the person I saw that commented on this uh, showed that whenever that's happened a year out, the market has these giant gains. Of course, a lot of those times, though, before a year out, the market has big losses too. So it's not necessarily a reason to just get all excited about the market in itself. And it's still, look, is this market rally for real? That's the real question. Yes, it's exciting to see a couple of days up, but that's in context of the stock market being down for over 9 months. It had fallen almost 10 days straight down before the three updates. But let me show you some of the stuff I'm seeing on Twitter, and we'll dive into the charts and try to navigate this situation. This kind of sums up. Um, Helen Meisler is one of the smarter people, I got to say, that I follow on Twitter. She's a technical analysis expert, and she's got a good following of people. And she did a poll, and 58%, 4,300 people responded to it. So there's a lot of people, and 58% of those people are predicting a 100-point move up in the S&P 500. So the bulls are winning on that poll, and what I'm seeing, that they are representing the majority of the comments. However, I got to say, whoever this is, I think they got the comment that really sums up the true situation. Market rallies just enough to turn everyone bullish again, then it drops. Isn't that what happened just at the end of August? And then he writes this: market drops just enough to turn everyone bearish again, then it rallies. That kind of sums up the stock market this entire year. I got to say, things look so dire in May, and then and then it rallied, and everyone got so excited in August. People are talking about Fed pivot, the Fed lowering interest rates, predicting that inflation would go away, rationalizing reasons to believe that the July move that continued into August could be the start of a new bull market. And what happened as soon as everyone got all in and you saw the end of that rally, the meme stocks exploding, boop, it was the top, and bam, we smashed down. But 3 days up. So let's look at that. The S&P 500, the 3 days up. Now, in August, when we rallied up to the down arrow line I have on this chart, we rallied up to what was the 200-day moving average on the S&P 500. Same thing happened on the Nasdaq and the Dow, and we failed to close above that level. That's critical because by my definition, a bear market is a market which trades below that moving average, below the 200-day moving average, and that moving average acts as resistance. And it's been doing this all year, and it did it once again just last month. The rally up to resistance, the resistance failed. Now, in a bull market, the opposite happens. And when you did those moving averages acts as support, typically you'll get one pullback a year, sometimes two, that represent wonderful buying opportunities. But we're not in that type of market environment. We're in a more bearish market environment. And I'm going to hold that opinion and continue to keep that opinion until that moving average is closed above with some decisive breakout rally, and then begins to act as support. So oil and commodities are more, is generally, they're more bullish than the stock market is, and it continues to be the case. You could say interest rates are in a bull market because they're trading above the 200-day moving average too. But when the market pulled back off of that 200-day moving average, you can see it fell like almost 2 weeks straight down, just about. Um, and it fell enough that the indicator on the top, the stochastics oscillator, went below 20, which means that's an oversold reading. And on Friday, both the stochastics closed above 20 to give a buy signal. So we got an oversold market, or we came into last week with an oversold market condition. We ended the week with a buy signal. That's not my opinion. That's what happened. The thing about that, though, is if this was a bull market with the averages above the 200-day moving average, I would say that was a real buy signal, because you can get false buy signals that happen when you're not in a bull market. And as you can see, you could have seen such false buy signals in February, in March, in April, in May, in June. The one in June finally triggered a real rally, I would say, back up to the 200-day moving average. But, this is a tough market. Look, don't let anyone kid you on that fact. I don't know how long you've been in the markets. I've been in the market since the 90s. And this is one of the more difficult years I've ever experienced. And it's just the way it is. And I'm not going to sugarcoat things. I'm not going to lie to you about that. It's what it is. Now, the thing is, when you get a buy signal like this, and everyone's expecting a rally now, the real question is, how far will this market really rally? Will it do like it did in May, when the S&P 500 popped up to 4,200 and then got slammed down in the second half of June? That would be like another one up day next week, hopefully. And then the market would just go sideways and start dumping by, the week after or so. Or does this just not even do that? Does it just make a reversal on Monday or Tuesday? The best case scenario is we rally back up to the 200-day moving average. But that's, it's not very likely. So that's why it's really difficult to buy these type of rallies and play them, because you got to get out if you want to make any money. If you're in a bull market, you just hold, and by the end of the year, you're making a lot of money, but you're not. So you're forced into day trade. And that's why when you look at things such as the order flow and Fidelity, what you're seeing is a rise in manic day trading. You're seeing less people, think about the people you talk with, the people you see on the internet actively trading the market. They're trying to play meme stocks for quick gains. They're not buying like Apple and saying, I'm going to hold this stock because it always goes up, and they're going to tell you about the Apple phone and tell you all these stories. No, they are trying to make quick money because they know the money gets pulled. It's like the rug will get pulled out of the market. So they got to make the money quick before that happens. That's what a lot of people are trying to do. And that's a hard game. But that's what most people are doing. It's not the game I'm trying to play. But that's what the majority of small traders in the market are attempting. So the thing is that when we look at the market, there has been no fear on this decline. For example, this is the VIX, the volatility index, sometimes called the fear index. It's below 23. It fell last week. It just fell Thursday and Friday. It fell all week and made a low below the low of the previous week. And this is an important indicator because it measures the premiums that people are paying for puts in the options market. And when they get scared, they scramble and the premiums go up. And when you get over 30, that shows stress and some anxiety in the market. When you're where we are now, the volatility index is in line. It's not showing fear. And it's also in line with the true volatility of the S&P 500 this year. So this will get out of whack when you have real fear and panic. There's no real fear and panic. And I don't like, in a bear market, I like to buy or look for a bottom when there's fear and panic. There is none. And even in bull markets, you'll typically fear and panic, once a year. There is none. So this, to me, this is not a buyable rally. But look, I don't have the computer algorithm that's going to predict to me, at what exact price it's going to stop and if it's going to reverse. And I don't think those algorithms really exist or at any degree of accuracy. It's not really what the true algorithms are about. The hedge funds are using, but that's another story. But here's the bottom line. People want to buy stocks. People want to trade. They want to jump in meme stocks. So they're looking for signs that are big rallies. They see the market go up for 3 days and they're now excited. That's what's happening. That's where we're at as I'm doing this video this weekend. And what's the daily gyrations is what people focus on, but it's useful to step back and look at the big picture. And this is a chart going back to 1990. And you look, we had 2 giant bear markets up until this one in 2000 to 2002, and 2007 to 2009. They lasted a long time. And to me, the situation now is similar to the summer of 2008 or the summer or the fall of 2000 or the summer of 2001. I'm saying that not to suggest that we're heading for a 2008 style crash, but that we're just like halfway through the bear market, most likely. I don't think this is really going to end to next year when the current cycle of the Federal Reserve raising interest rates gets to an end and we get into a trough in an economic slowdown or recession, which isn't likely to happen until the second half of next year, possibly the fourth quarter. And typically the stock market will bottom out 90 days before then. So bear markets happen and it's not the end of the world. And we're linked to this. This is the 10-year Treasury bond yield. And look, in July, the yield pulled back. It went up to 3.5%, then it pulled back. And people were coming out who wanted to find reasons to believe that the stock market was rallying, looking at the pullback on this yield and claiming, interest rates are going back down now. The Fed's not going to raise rates. The Fed's going to pivot. The Fed will be cutting rates before the end of the year. Or we can get back down to 1 or 0. So buy stocks. This is what they did in 2020. This is what they did in 2018. This is what they did in 2012, 2016, 2011, either cutting rates or new QE. Get in, the Fed's your friend, pivot, pivot, pivot. And that whole story became mythical. And it was nonsense and shown to be nonsense when Jerome Powell destroyed it at the end of August. At the Jackson Hole meeting, and now interest rates are creeping back up. So look, when you look at a big picture of interest rates, this chart doesn't go back to 1980, but interest rates have been falling since 1980, and then they went to 0 in 2020, and now they've been going up. We're in a different market environment than we have been in since 1980, since 2000, since 2008 for that matter. You see, since then, interest rates were in a secular downtrend and decline, and the CPI inflation rate never got above 2% for any meaningful amount of time. And interest rates went to 0 in 2020. 0 was the lowest level of interest rates ever in the history of the United States. In Europe, interest rates actually got negative. And that was the first time in human history that there was ever negative interest rates. And when that happened and Fed rates went to 0, what that meant was that never again will that be seen. Something that only happened that time in human history is never going to be seen again in your lifetime. I'm talking about thousands of years of human history, financial, recorded history, right? There are no negative interest rates in the Bible. Maybe sometime I'll do a video about what the Bible says about interest rates in ending debt situations, but the solution is not negative interest rates. It just doesn't talk about them because they never existed until the recent couple of years. Now they're gone. They're going away. They're gone. Never going to come back. So what this means is that this chart of the 10-year yield, the bulls that want to say, oh, rates are going to go to zero, or we get down to 1% on the 10-year yield, it's nonsense talk because we're in a different environment. As evidence of that, look at the inflation. Inflation has exploded like it hasn't been this high since the 1970s. We're not going back to zero rates. Yeah, we're in a secular environment of rising interest rates. I believe before the next 10 years are over, we could see interest rates go to 10% on the 10-year bond. Now, I don't think that's going to happen next year, and we can get pullbacks in the yields like we saw in July. We could see the Fed fund rate go to 4 or 4.25 in the next 6 months, and then go back down to 3, and that's it. And that would be the rate cutting cycle. That's it. Yeah, I'm not trying to predict exactly how things are going to play out. All I'm trying to tell you is we're not in the whole macro environment's different. Now, to underscore all this, I want to tell you about this story. This is the Wall Street Journal. And I want to suggest to you that if you want to be successful investing or trading the stock market, you've got to get away from looking at the daily gyrations and obsessing over them and focus on fundamentals, big picture situations, which I've just been talking about. And this is a story. September the 7th. I'm just going to read you a couple of highlights because it's important. Junk loan defaults trigger jitters about a credit crunch. So, defaults on so-called leverage loans hit $6 billion in August, the highest monthly total since October 2020, when pandemic shutdowns hobbled the U.S. economy, according to Fitch Ratings. Interest payments on loans float in lockstep with benchmark interest rates set by the Federal Reserve. So when you see this chart of the yields going up, it's causing the mortgage rates go up, but so do the cost for companies to finance. It's not just the cost of you if you want to take out a mortgage, but the cost of the corporations when they want to go loan, when they need to borrow money, they got to pay higher interest. When companies issue junk bonds, they got to pay higher interest on the new debt, and that's what's happening. And so the rise in rates is causing jitters about a credit crunch. It's not causing a credit crunch now, but it's causing jitters of one to come. Now, here's a quote about what's happening, what we're coming for, what we're heading to this fall. Borrowers are particularly vulnerable to the double whammy of weaker earnings and rising interest rates. Says the Morgan Stanley person. That will trigger a wave of credit rating downgrades and push average loan prices currently 95 cents on the dollar below 85 cents, a level breached only during the 2008 financial crisis and the depths of the COVID-19 pandemic. What this means is that we are headed for lower prices and declines in the value of corporate bonds. And historically, declines in the value of corporate bonds bring with them declines in the stock market and declines in banking stocks. In fact, the corporate bond market made a secular peak in 2020 when interest rates went to zero in as I was saying, the lowest level in global yields in human history. The value of corporate bonds reached levels never, the heights they've never seen ever before, and they've been going down ever since. And the bear market in stocks that everyone's all focused on was preceded first by a decline in corporate bonds. Corporate bonds began to decline before the stock market did. That's what happened. And so watch what happens in corporate bonds over the next week. If they don't rally to confirm the recent 3-day move in the stock market, then you know that move in the stock market is bogus, and you should not buy into it and be fooled by gurus who tell you to do so, no matter who they are and what TV show they're on, or how many people follow them on YouTube. One more point I want to make. One thing about this, we're not headed for a corporate. Yes, some companies are going to come under more stress, but we're not on the verge of a mass corporate bankruptcy thing because of what I just told you. Even if it is bad, even if it is costing companies more money, even if it makes stocks go down a little more. Because when the pandemic came, the federal government created these bailout programs and lending programs, zero interest, that most corporations in the United States took advantage of. For example, I follow some of the casino companies, and most of the casino companies borrowed over $2 billion in 2020. They borrowed enough money to keep themselves in business for over 2 years, even if they're not able to reopen. Exxon did something similar. Microsoft. Most American corporations still have huge cash on their balance sheets because they took out massive loans to generate such cash in 2020, and they are locked in at 2020 rates on those payments for those loans. But this is the true problem with everything in the financial, with the economy, the financial markets, everything. This is the true problem. To be sure, this is reading from this article. To be sure, most borrowers don't have to repay their loans for several years, giving them some breathing room. I'll just explain that to you. Even among the companies at greatest risk, about 75% of their loans mature in 3 years or more. Now, they have a chart showing when the loans mature. And it starts to pick up in 2024. And after that, every year it gets bigger and bigger and bigger. In other words, when you step back and look at the long-term fundamentals of stocks, American corporations, they are facing an explosion in the cost to finance the debts they're in. That's not going to start tomorrow. It's not going to start next year, but it is coming down the pike in a few years. And there will be many companies that go bankrupt as a result of that, because, just imagine if you have a mortgage on your home. Say you've got a home worth $500,000 on it, and you have an adjustable mortgage that's going to adjust in 5 years, and you bought that home at interest rates a year ago, and then you're going to see the payment go up 5 or 7%. That sort of situation can be devastating for people whose incomes don't grow, and this is going to be a big problem. Now, I'm not saying that the stock market is going to fall for year after year after year, or be okay for the next 2 years, then crash when all this happens, because the stock market tends to price things ahead of time. And I think this situation of what will happen in 3 to 5 years, or in a 3 to 5 year window, will be priced in when this bear market is over, and I cycle. And I think this cyclical bear market will end next year. But this is something no one is thinking about who's paying attention to the daily gyrations. that they saw on Friday, Thursday. And you got to think ahead. And the bottom line is, what's the takeaway here? You don't have to do anything in the market now. You don't have to be chasing rallies. It's not a rally to chase. It's time to be patient and let the bear market work itself out and come to an end before doing serious buying. That means ignoring the hype that so many people are delivering to you. And unfortunately, when it comes to the way the algorithms work on the internet, it's hype that people want, and that's what they deliver them. So I don't even know if this video will get, how many people even watch it, much less watch it to the end. So anyway, if you want more videos like this, hit the like button. If you're totally new to me on YouTube, hit subscribe, hit the bell, and YouTube will send you an alert as soon as the next video is up for you to watch.